The US votes for gridlock and US equities close at 4-week highs. The US midterm elections delivered widely expected outcomes in terms of control of Congress. President Trump's Republican colleagues strengthened their hold in the Senate, but lost the House for the first time since 2010. In terms of market response, the US dollar and US bond yields are up modestly, but US equity markets closed at 4-week highs on Wednesday, perhaps a reflection of the fact that a Republican president and split Congress has historically seen equity markets thrive. While it's hard to read too much into the 5% rise in US equities over the last 5 days, there does seem to be a sense of optimism that the House and Senate may be able to work on legislation that includes infrastructure spending, which is an area long favoured by the Democrats and Trump. However, deep partisan divide seems likely to ensure that many proposals passed by a Democrat-controlled House are blocked by a Republican-controlled Senate before ever reaching the president's desk. Signature legislation thus faces a tough uphill battle. So it's arguably a mixed outlook, perhaps overall implying slightly slower US growth, but it surely won't be enough to stop the Fed from hiking in December, but also a further 3 times in 2019, according to Westpac's forecasts, which were updated this week. Westpac now expects the Fed to pause the hiking cycle at a peak of 3.125% from September next year. Now, the Fed did not give an explicit signal for a December hike in the Federal Open Market Committee meeting yesterday, but that was not necessary, with markets fully pricing one in. While equity markets have been more upbeat this last week, the same cannot be said for crude oil markets. West Texas Intermediate, the US benchmark, is down 20% from the highs seen just 5 weeks ago on October 2. And it's worthy of note that we've seen some important geopolitical developments in Saudi Arabia over that period. On October 2, journalist Jamal Khashoggi died in the Saudi consulate in Istanbul. On October 23, Saudi Energy Minister Khalid al-Falih told a conference in Riyadh that OPEC and its allies are in produce as much as you can mode. And yesterday, the Dow Jones Newswire ran a story suggesting that Saudi Arabia's top government-funded think tank is studying the possibility of the effects on oil markets of a breakup of OPEC. Now, 5 weeks ago, many were talking in the market of the possibility of $100 crude oil. As of last night, crude was down 20% from the high, meaning it's technically entered a bear market. While the prospects of lower petrol prices here in Australia were not on the RBA's mind when they met Tuesday, the mood appeared pretty upbeat. The forecast growth rates for 2018 and 2019 were revised up from 3.25% to 3.5%. The forecast for the unemployment rate by 2020 has been revised down to 4.75% from 5%. And this more upbeat mood appeared to help the Australian dollar these last few days. We hit a high on Thursday of 73 cents. Now, Westpac does not expect the strength to last too much longer. We're still forecasting 72 by the end of 2018 and a further leg down to 68 cents by the September quarter next year. While the Australian dollar saw strong gains this week, the New Zealand dollar was stronger still, hitting a 3-month high above 68 cents. The Reserve Bank of New Zealand added some weight to the move yesterday by removing the reference to the next move in the cash rate potentially being up or down. Foreign exchange markets have been very focused on the remotest possibility of a rate cut. The removal of the word down helped the Australian dollar against the New Zealand dollar cross down to 107, a 5-month low. Now, next week brings an important run of Australian data with NAB business confidence on Tuesday, Westpac consumer sentiment and Q3 wage price index on Wednesday, and the October employment data Thursday. All of these argue for more volatility in the Australian dollar next week too, and this is something we'll talk about in next week's Markets Update.